Hi, everyone, and thank you again for joining us today. My name is Marissa Eastman, and I am the Skills Development Coordinator at RTI International. RTI works jointly with NHLBI to support the Catalyze program by providing resources beyond funding to academic investigators and small companies that are looking to commercialize a heart, lung, blood, or sleep technology. And one of the resources we offer is skills development opportunities. In addition to our monthly webinar series, which of course today's webinar is part of, we also host a 2-day annual meeting in September, October. We send out quarterly newsletters and have a curated bank of online material to support investigators throughout their commercialization journeys. So if any of that interests you, there will be an email to contact at the end of today's presentation. So without further ado, I am very pleased to kick off our first webinar of 2023 by welcoming back Dr. Steve Flaim as our presenter. Steve is a senior special advisor and investor in residence with the Office of Innovation and Commercialization at NHLBI and an entrepreneur in residence in the SEED office. Today's webinar is geared towards the academic investigator and will cover when and how to form a startup, key features of investable startups, and how to market yourself and your technology. Today's presentation is being recorded and will be made available at the end of the week with a downloadable copy of the presentation slides on our website at NHLBICatalyze.org. All right, Steve, I will turn it over to you at this time.
Great. Thanks very much, Marissa. It's a pleasure to be here with everybody. Let's see here. I need to figure out how to advance my slides. And that's not, there we go. So again, the agenda for today is, we're going to spend a little bit of time on talking about how to, what are the steps, the early steps in when and how to form a company. I'm going to spend a little bit of time talking about capital resources, because in forming a company, you really have to think about funding and setting yourself up for future funding in investability issues. The third thing we're going to look at is what are the key features of investable companies, and then what are the important considerations in developing a pitch deck. And we'll spend a little bit of time on that. And then finally, I'm going to run through a sort of a template pitch deck to give you an example of what you need to consider. So I want to bring up my laser pointer, but I don't seem to find it. It's okay, I don't need it. So when and how to form a company. So there are different stages of companies. The early stages are idea, proof of concept, seed and startup or launch, and then later stages are growth and maturity. We're really going to focus on the first two parts of this sequence. So it's a much longer process, but we're going to really look at these first two steps here. So from my perspective, the first thing that you as an academic investigator needs to think about, if you think you've got a technology that could be a commercial opportunity, you really need to focus early on what is the intellectual property that you could develop or you have developed to protect this technology. And when I say intellectual property, I'm talking about patents, trademarks, copyright, trade secrets. These are all features of what I would call barriers to entry to prevent others from coming in and selling products in your space. Important things to think about here are, in terms of patents, are they US patent applications or issued patents? Have you extended, or can they be extended to countries outside of the US and to worldwide opportunities? And you need to think about this from the standpoint of what exists today versus what could be developed, or what you have in mind for planning for IP protection. Issued versus application is really important. So the dates of issuance or the dates of application, if their applications, has there been any office action on those patents? Also, is there freedom to operate? And what that means is, could you sell your envisioned product into the market without infringing on somebody else's intellectual property? And a freedom to operate assessment can be done as an informal assessment versus a formal assessment. These will cost money. Informal assessments could cost as much as $5,000 or $10,000. Formal could be much more than that using a law firm. So the next step is, does the IP actually exist? So if there's no IP at this point in time, you need to think about hiring a patent attorney and starting the process for developing a patent portfolio before public disclosure of your technology. And what I mean here is you should be developing your patent process before you publish your data in scientific journals, for example. So you should know the rules around the US and the ex-US patent requirements relative to publication and disclosure dates. Who owns the IP? If it exists already, who owns it? Is it the university where you're located? If so, then you need to be sure that the technology that you have in mind is disclosed to the tech transfer office at your university as quickly as you possibly can. And then you need to, in the back of your mind, be prepared to negotiate licensing terms with your tech transfer office, because you're going to want to license the technology into your startup company. If the technology or the patentable information is owned by another entity, you're going to need to be negotiating with that entity to acquire rights to the intellectual property. And you have to realize that the company that you're going to start is going to need to own or have rights to the intellectual property license. And my advice to you is early on to seek legal advice on how to negotiate with such entities. So step two, once you've kind of figured out what the intellectual property situation is or could be, you need to start thinking about forming the company. And the company structure is extremely important. And let me just talk about this for a couple of seconds here. There are different structures. There's the C Corp, the S Corp, the LLC, the sole proprietorship, and there's a number of other ones as well. Realize that investors who you will need to be talking to will want to insist on your company being a C Corp. So that's really important. You need to think about that. You can start with an LLC, but they won't invest in you unless you're a C Corp. And my advice to you is to incorporate your business in business-friendly states, such as Delaware. Delaware is the preferred state to incorporate your business. There are other states that are good, that are friendly as well, but Delaware is always the best one. So what are the requirements for a C Corp? You're going to form a C Corp. The first thing that you need to do is you need to have a chief executive officer. This person could be full-time or part-time, at least initially. A part-time CEO is okay, but that person needs to be prepared to go into full-time commitment, especially when raising funding. The CEO ideally has some prior relevant experience. It could be experience in a C-level position in another startup. Ideally, they've done a startup as a CEO in the past. Those are the ideal kind of situations to have. The second most important thing here is a C Corp, you're going to need a board of directors. And a board of directors ideally is going to have an odd number of members. You can start with 3, but 5 board members is better than 3. And that's my opinion, simply because it gives you a few more people to interact with. And remember, the CEO reports to the board of directors, but the board of directors really is there to help the CEO be successful with the company. Your board, ideally, from an investor perspective, should be outsider controlled. That means that more people are on the board that are not paid by the company versus people on the board that are paid by the company. So the ideal 3-member board would be the CEO of the company, and then 2 outsiders that bring in some value or experience that's needed by the company at that early stage. And I advise you to avoid bringing in names of famous people, because usually those people they provide a marquee value, but they really don't add very much value because they're busy and they don't have a lot of time. So bring in people with the experience that you need for your the early stage of your company. So the next thing I just want to talk about here is one of the first things you're going to do as a board of directors is you're going to authorize stock and set valuation for the company. You will also need to authorize an incentive stock option plan that will be used to incentivize employees and to compensate board members and advisors to the company. So this is an early stage step that you need to plan on taking. And then I advise you also to early on think about acquiring directors and officers insurance, mostly because good outside board members will not take a board position without some kind of insurance being protected by the company. And then finally, I advise you to bring in legal counsel to help you put all of this together. Once the company is formed, you then immediately need to obtain rights to the intellectual property that you already know exist. And again, I advise you to retain legal counsel representing the company, because you're going to negotiate with the entity that owns the IP if you don't already own it. And the negotiation should establish terms for the license that are friendly to the company. Investors will want their money to support the company development, not the university or the holder of the IP. So that means that the license terms should have low upfront and milestone cash payments. They should have ideally single-digit royalty on early stage product revenue, and generally should be backloaded to benefit the licensor as opposed to front-loaded to take money out of the company. Ideally, you want to have worldwide rights to the IP for multiple indications if possible. And ideally, you also should try to acquire right to sublicense the technology, depending upon geography or indication. Now let's talk about funding. First thing I want to mention is the early stage sources of capital for startup companies. So they're listed here: founders, friends and family, and also non-dilutive capital. So the non-dilutive capital can be from grants from, for example, NIH, the SBIR Phase 1 program, for example. There's also nonprofit sector-specific organizations, like, for example, the American Heart Association or the American Diabetes Association, that give grants. These are non-dilutive funds. They're basically starter money. The problem with this kind of money is that it takes a lot of work to get, and it's slow to come. But it does provide validation of the company and of the technology to subsequent investors. And it helps you reach out to investors for additional fundraising activities. So this is a slide basically summarizing the over time how a company develops, where they get their money from, and how much money they can get from these different sectors. So the vertical axis is cash from revenues. The line across the center is the zero line, and the dark line that falls down and then goes back up, that's revenue, which goes negative in the early stages of the company. And around the time you get first revenues, it starts to change directions. And if the company is successful, it gets into the positive side over on the right. And you can see that you're going to be basically negative revenue for the idea and innovation stage and the prototype stage. And eventually, as you get further on, you start to get positive revenue. So in terms of the innovation stage, this is pre-seed. You're going to be burning about $1 million or so. This is going to come from accelerators, crowdfunding potentially, government sources, friends and family. Prior to that, you're probably going to fund this yourself. And then when you go to the prototype stage, that's when you start to get into the seed stage. And this is where angel investors really come into the picture. And then subsequent to that are much larger amounts of money, Series A, B, and C, et cetera. And this is where venture capital firms get involved. And eventually you can do an IPO and you can borrow money from banks on the far right side. But for the purposes of today's discussion, we're really going to be focusing on the idea, innovation, and prototype stage. And I'm going to focus more on the angel investor side of things. So before we go there, let's just talk a little bit about the amounts of money. So I mentioned this a little bit in the previous slide. So founder, friends, and family, they're going to probably help you with raise about $200,000 maximum. When you go to angels, they're going to raise somewhere between 50,000 and up to 2 million, depending upon how large the angel group is and how big of checks they can write. Venture firms will raise over $1 million. And then you can raise quite a bit of money from crowdfunding, and eventually banks can loan your company any amount of money once you get to the far right side of that previous graphic. So the differences between angels and venture capital, and I really want to make this point clear. Angels are high net worth individuals who invest their own capital and their experience with the intent to create value and to help the local economy. That's their main driver. The venture capital firms are firms that have invested money and they hire professionals to manage the money. And the intent of venture capital firms primarily is to create value greater than what's available through traditional investment tools. So they're really more interested in earning money for their investors, as opposed to angels that have other things in mind in terms of local economy development. Okay, now I want to spend a few minutes talking about the key features of investable companies. So, and this essentially is what angels are looking for. They're looking for a unique product or service that solves a problem or relieves a pain that is worth solving. And this could be a market over $100 million, ideally more than that, and can be reached using some kind of a distribution strategy with an experienced team that can execute and is capital efficient with an exit potential. And what I mean by exit potential is that the investors get their initial investment back with a multiple. They're not looking for an annuity. They're looking for an exit, maybe a 10x exit. So what angels look for in an investable company are a balanced, skilled, and experienced team. These are ideal situations. The problem is important. The solution that you have is working, and there's evidence that it works. The value proposition is clear and good. Ideally, you've already talked to potential customers, and they have shown interest in your technology. You do have a sustainable competitive advantage over what's already out there in your space. You have put together some kind of a go-to-market strategy that is a reasonable approach to commercializing your product. And you're proposing an adequate raise that's based on a solid financial plan. And finally, you do have an exit strategy in mind with timing and a multiple that is attractive to the investor. So let me just go through some of these points about what are of interest to investors for early stage companies. So first of all, let's talk about the CEO. Ideally, the chief executive officer is a very coachable person, somebody that the investors are going to want to work with, be in business with over a period of time. That person needs to have integrity. Ideally, they have prior experience in a position like this, leadership position. Ideally, their experience is in a vertical that is similar to the vertical that your technology is in, so healthcare, for example. And that person comes with a set of team members that are identified that could be brought into the company to help move the company forward. And that team should be balanced and complete. It should have both business and technical experience and the things that are important in moving an early stage company forward. And ideally, they have experience working together. So these are all ideal situations, and I understand that some of these are not, 100% of these things are not going to happen, but these are the ideal things to be striving for. The market should be, there should be evidence that the market is scalable. And what that means is that within 5 years, you should be able to achieve at least $20 million in revenue 5 years into your business. Venture capital firms look for more than $100 million a year 5 years in. Now, I realize that this is a little bit hard to do sometimes with healthcare technologies because of regulatory hurdles and so forth. But these are the kind of things that early stage angel investors are looking for. There should be a large niche market with high revenues and ideally with minimum competition. And your margins should be large with growth available through internally generated cash if that's possible. That is helpful because it requires less investment, capital investment. The product should be available for customer validation. You should be able to point out to the investors that there's customer interest. There is a prototype, and maybe it's even at a beta stage where the customers have had a chance to look at it and test it, and they want it, and there's evidence of that. The technology should be unique. Again, you should have patents and trademarks and barriers to entry that we talked about earlier, identified and in place and licensed into the company. And your product should be manufacturable, and you need to be able to validate the ability to manufacture it in quantity. We talked about patents a little bit. So patents, trademarks, trade secrets, these are really a must-have, but I just want to point out here that patents are not so valuable to the early stage company. They become valuable when you license your technology to outsiders or to partners, or if your company gets acquired by a larger organization. That's when an issued patent becomes extremely valuable. So just keep that in mind in terms of valuation. Customer validation needs to be available. You should have thoughts on marketing and branding in mind. There should be reasonable sales channels that are defined. And ideally, if you have partnerships that are established with firms that maybe are doing engineering, maybe some marketing, sales, those kind of partnerships are valuable to investors. And then your competitive advantage clearly needs to be identified versus the other products that are competing in your sector. So now I want to turn to important considerations in developing a pitch deck. Before we get into the nuts and bolts of that, I do want to point out that most investors, angels and venture capital firms, will not sign non-disclosure agreements. And the reason for this is that they see too many deals. If they signed NDAs with all the deals they look at, they would be completely locked up and they wouldn't be able to do anything. Investors they have to rely on their integrity in order to do business. They are not motivated to steal technology. So you need to trust that they will not disclose important things. However, there are certain situations where you may say, this bit of information is really confidential, and I need an NDA to protect this piece of information. And so if you bring that up to the team from the investor organization that's doing due diligence on your technology and on your company, you can say to them, look, I've got a really key piece of information here, but I don't want to disclose it to you until I have an NDA. And most firms will sign an NDA covering very narrow set of issues in order to see that key piece of information. Usually it's one person from the team, and that person can evaluate that information. And if they agree that it's super important and very beneficial, they can then go back to the rest of the investors and say, yeah, they've got some key IP, or there's some key secrets here that are really important, and we need to invest in them, but I'm not going to tell you what it is. And then finally, in terms of business plans, don't include proprietary information. Just don't do it. I mean, you would be surprised at how much information you have that really doesn't have to be considered proprietary. So in your business plan, Give them all the information they need in order to define your business as a good investment, but don't include really confidential proprietary information in business plans. Now, this is a list of key points that I find myself advising companies on all the time in terms of what to do about pitch decks. So the main point I want to start off with is that you're probably going to be limited to about 10 minutes in your first pitch to an investment group. 10 or 15 minutes is usually the maximum. And the idea here is to get a second meeting. So, and the other thing that's important is that 10 minutes, if they tell you you got 10 minutes to present, you got to honor that. Don't go over 10 minutes. If you go over 10 minutes, that's really the kiss of death. So ideally, if you have 10 minutes, you're probably not going to want to have more than 10 slides, and you're going to move through those fairly quickly. I advise people to use PowerPoint wide format and slide numbers on your slides. These are issues that really are important to the audience, and it helps get the information across. Use a large format font. It needs to be visible and readable from the back of the room, and sometimes these rooms are kind of large. So be sure that your font is large enough to read from the back of the room. The presenter of the pitch should be the chief executive officer, or certainly the business lead for the company. And the reason for this is that investors want to know who they're investing in, and they want to see the CEO. They want to see how the CEO can present, whether they can answer questions properly. And so ideally, the CEO is the presenter for your pitches. A pitch is a business presentation, not a science presentation. Remember that you are selling your technology to investors. So you're going to have some science in, but it's not the typical science presentation that an academic investigator would present to other scientists. This is being presented to a business group. In your presentation, you need to make your claim, but you don't have to substantiate your claims. And so a lot of times scientists, they'll put up a statement and say, you know, this technology works, and now here's all the data that says and proves that it works. You don't need to do that in a 10-minute pitch. Just tell them what it is you want them to know. And if they will definitely come back with questions afterwards, and you can provide them with all the data that you have to substantiate your claims. The goal of a 10-minute pitch is to get the next meeting. So remember that is the goal going into a pitch session. In terms of text on slides, use bullet points. My advice, again, remember the font needs to be readable from the back of the room. My advice is your bullet points are single line statements, not full sentences, and it's just the key information that you need to telegraph the important information that you're trying to get across. As a speaker, delivering this pitch on the slides, what you say should be reflected in the text on the slides, but you're probably going to be saying more than what's on the slide, because you want the audience to listen to what you're saying, but also able at the same time to read the text. So it should coincide with the text on the slide. Avoid public solicitation of funds. So this is an important point that I just want to, I'll probably spend some more time on this later, but the Securities and Exchange Commission has stated that if you talk about fundraising activities in an environment where a public environment where the audience is not fully accredited as investors, you're doing what they call a public solicitation of funds. This is not illegal. However, it will make it more difficult for some types of investors, especially angel investors, to invest in your company after you do this public solicitation of funds. So we advise you don't talk about future fundraising plans or activities, amounts, terms, that kind of thing. Don't talk about that. And I'll give you some examples on how to get around that, but still get the information out. Again, I mentioned this earlier, don't put truly confidential information in your pitch, but put enough information in there to attract interest and to get that second meeting. And then finally, what's really important is practice. Practice your pitch over and over again in front of a timer, and be sure that you can get the key bit of information out in that 10-minute or whatever the time limit is that they're giving you. So lots of practice is really important. All right, now I'm going to run through an example template for a pitch deck, and we'll try to do this quickly so that we don't run out of time here. But so the first slide is going to be the title slide. It's going to have your company name and logo on it someplace, and a tagline. And this is really important. The first slide, when it goes up on the screen, should tell the audience immediately what's coming. So your short tagline, again, is not going to be any longer than what you see here on this slide, but it should telegraph the information that's coming. So, we're developing a technology to improve, diagnostics for COVID-19 or something like that. That really tells clearly what you're doing. Avoid high level, we're going to improve healthcare kind of thing. That doesn't really help. Your title slide should also have the name of the presenter, the title of the presenter's title in the company, and the presenter's information. So when you put this slide up, you're going to say, "Hi, I'm Steve Flaim. I'm CEO of Nuco Inc. We are developing a blah, 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 whatever the technology is," and that's your tagline. So that's a very important slide in a 10-minute pitch. Define the problem. So your problem slide, you're going to explain what the problem is and the unmet clinical need. What's the current standard of care or protocol? Highlight the problems with standard of care, the inefficiencies, gaps, or suboptimal outcomes or process that exist, safety or market access that your technology will overcome. The solution, how does your technology solve that problem? As far as data is concerned, you do need to have a couple of data slides, how your technology works, whatever proof of concept data, in vitro, in vivo, preclinical, or human, that supports that assertion. I will always tell you to defer to the most advanced data that you've got. So if you've got human data, focus on that. That's super helpful. Avoid jargon, terminology. Just, you got to keep it simple. You got to realize that your audience, they may be software experts, but not healthcare experts. So you need to be able to explain to them what you're doing and why it's important. In terms of healthcare technologies, you also need to mention that you understand that there is a reimbursement strategy that needs to be developed or is developed. There's a plan for that. And why does your technology improve healthcare economics? What's the benefit? What's the value to healthcare and healthcare costs? And then once again, don't include confidential information. There's always going to have to be a market slide. This is a typical slide that talks about total addressable market, abbreviated as TAM or TAM. It's like the total entire world where the technology could be used. How big is that market? Then there's the serviceable available market, or the SAM. These are jargony things that business people use. This is the market that you will likely reach either geographically or maybe in selected patients. And then finally, the serviceable obtainable market, or SOM. This is the percent of the SAM that you will likely capture. And if you claim you're going to capture more than 30% of the SAM, they won't believe you. So be conservative with that market. And values should be in currency, not size of population, et cetera. So you should be talking about dollar market amounts. There should be a slide on competitive analysis. And there are a couple of different ways to highlight the competition in your technology with respect to the competition. The one on the left, the table there, We call that the bingo slide, which I kind of like. I think it is the best way to describe your technology versus the competition. So you can see that across the rows, you have competitor 1, competitor 2, competitor 3, and then yours is at the bottom, or you can put yours at the top. And then across the columns, there's traits or features. And you can see that competitor 1 has check marks in 4 boxes. Competitor 2 has check marks in 3 boxes. Competitor 3 has only 2 check marks. And lo and behold, your organization has check marks in all the boxes. So what this does is it tells the audience, hey, I know what the competition is. I know what's good about the competition, and I know what's better about our technology. And I've done all of this work. And in a very quick, easy, without spending a lot of time on it, way this image telegraphs all the important competitive analysis information to the audience. We talked about intellectual property. You do need a slide on IP in a 10 minutes pitch. You can have all of this information on the slide. You don't really need to say a lot about it. All you need to do is have it up there. We have patent applications and PTCs. Add the numbers and the dates if you can, what patents are granted and the dates, et cetera. Differentiate between composition of matter patents and methods patents. Methods patents, by the way, are more difficult to hold up or protect in ex-US markets. Composition of matter patents are quite valuable. High-level summaries on a slide like this are good. There could be other potential barriers, such as specific know-how, trade secrets. You can state what these are in general without providing details. And then again, as I mentioned earlier, freedom to operate. If you have an informal freedom to operate assessment and it comes out positive in your favor, you should state that. It's okay not to have a formal FTO at an early stage, obviously, but if you have an informal one, that would be a valuable thing to talk about. Again, the IP slide can have the details there, but you don't really need to spend a lot of time talking about them. The audience will be able to pick that up quickly and understand that you have an IP portfolio in hand. There should be a slide on the project plan to exit. Major milestones should be listed. The timing for those milestones, so Q1, fiscal year 1, Q2, fiscal year 1, et cetera, going across these are different swim lanes. There's a $ swim lane here. I had mentioned earlier about not doing a public solicitation of funds. If you're presenting to a 100% accredited investor audience, here you can talk about, we're going to do Series A of 10 million at a certain date, et cetera. It's going to be a preferred equity round. You can provide all that information. However, if you're presenting to a pitch competition where the audience is not 100% accredited investors, talk about costs. So you can talk about money that you've already raised, and that would be in the past. That could be to the left of the swim lanes here. And then going forward, from today forward, the $ represent costs. So we anticipate spending, $15 million to get through our first clinical trial, or whatever the amount of money is. And so what you're doing is you're telegraphing to investors, oh, they're going to need to raise that kind of money in order to achieve that milestone. So that's a way to get the information out without actually doing a public disclosure, a public solicitation of funds. Let's see here. Oops. So in terms of the team slide, first of all, it's good to have headshots of the management team and a little bit of information about each one. Not a lot of text. Remember, the text needs to be readable from the back of the room. If the management team has experience with other companies, try to figure out a way to include those companies' logos in your pitch, in your team slide, if that's possible. The idea is to give the audience a quick snapshot of the team, the management team in particular, and the kind of experience that they have. You should distinguish between the management team the founders, the advisors, and the board of directors. So usually what we recommend doing is talk about the management team. Some of them are founders, some of them are not. And then some of them are board of directors, maybe the CEO. And then you might have a separate group at the bottom of the slides that summarizes your key advisors and your board of directors members. Again, headshots and titles, brief summary of what their experience is, and really usually only like one sentence maximum to, again, a bullet point to give information about those people's experience. And then finally, the final slide in your pitch deck is going to be a summary slide. And it should be basically a list of bullets that summarize the major points that you've made during your talk. So again, it's a 10-minute talk. At the end of the day, you're going to have 4 or 5 bullets. The last bullet should be what your ask is. So if you're looking for investors or strategic partners, say that. Say, we're seeking investors or strategic partners. This slide will sit on the screen during the Q&A, so it gets the most airtime of all your slides. Chances are in a 10-minute pitch, you're not going to be able to go back and bring up individual slides. You're going to have this slide up there. There's going to be Q&A, and the audience needs to be reminded what you said, what your technology is, what sort of information you have that proves that it works, how good is your IP, have you talked about reimbursement, healthcare economics, market size? Those are the main points that you're going to want to bring out in a summary slide like this. And then finally, you're going to repeat the company name, your title in the company, and your contact information. And they'll be able to ask questions while this slide is on the screen, and people that are interested can jot down your contact information and reach out to you for follow-up discussions or subsequent meetings. And so that is the gist of what I had to present today, Marissa. I'm going to turn it back to you for Q&A.
Great. Thank you so much, Steve. Like Patrick said, everyone, at the beginning of our presentation, we'll take questions from the Q&A. So if you do have a question for Steve today, please put that in the Q&A. If you are unfamiliar with using the Q&A, the chat box is also totally fine. And Patrick will go ahead and moderate our Q&A for us.
Yep. Thank you, Marissa. Excuse me. I also want to bring everyone's attention to the feedback poll. If you would just take a moment before you log off today to provide us with your feedback, that'd be great. But our first question here, Steve, what makes Delaware business friendly compared to other states? Are there specific tax implications or other aspects?
Yes, all of those things are true. Delaware is particularly interested in having business in the state, and so they don't have onerous requirements for businesses, and so it's just there's a lot of details in company formation in Delaware that's beneficial, compared to other states. I can't even go into the details. There's just a lot of issues that prefers Delaware.
Okay, next question from Maxine. Under the topic, what do angels want? You mentioned having an exit strategy. Can you elaborate on this part as to what this might look like?
Sure. So when I refer to exit strategy, I'm talking about exit for the investors. So for example, let's say that I'm going to take a couple of minutes here and get into this because it's really an important point. Let's say that you go out to angel investors and you tell the investors that your company today is worth, say, $3 million, and you have to justify that and so forth, and that we need $1 million more to invested to move the company to achieve the next major milestones. So if the investors agree to put in $1 million, the company's immediate post-money value is $4 million. And the investors own 25% of the company. So they own $1 million. The company is worth $4 million. And now you can go forward and add and achieve your milestones and add value to the company and hopefully develop, achieve milestones and make the company even more valuable. So the next round, maybe your pre-money value will be 10 million and you'll raise another, maybe 3 million or something like that. So it's a matter of taking the money that the investors put in, achieving milestones, making the company more valuable. Eventually, you get to a point where you're now ready to sell the company. For example, I mean, there are different ways to exit. But if you were going to sell the company, say, for $20 million after a couple of years, the investors that put in that $1 million, their value, their investment has now grown to maybe 10 million or something like that. I mean, they haven't put in additional money, but their money has grown in value because of the work that you've done using their early stage investment. And so the investor that put in $1 million, when you sell the company, they're going to get $10 million back. So that's what I mean by exit. So you're exiting your investors so that they get a multiple of their original investment back as profit. So that's what I mean by exit. Hopefully that answers your question.
Okay, next we have a two-part question here from Andrea. First part, how do you find a CEO? And then what can you share about submitting SBIR and the work associated with this stage of a company?
Yeah, good questions. The CEO search process is probably one of the more difficult things that you'll have to do. So basically, there's a couple of opportunities that you have. If you have a very attractive technology and you have folks in your community who have been through this process in the past, they've exited their company, they're now looking for their next opportunity, they are the most qualified people for you to be talking to bring in as a chief executive officer. So some communities don't have a lot of folks like that. I live in San Diego. We've got a lot of them here. So that's your ideal situation to attract a CEO. If you have, so one thing that I recommend for folks that don't have good stable of ex-CEOs in your community or reachable is go to your business school and talk to folks in the business school and find out if they have classes where they're basically having executive MBA programs where they bring in folks that are in industry who are technology folks or clinical folks, but now they want to get an MBA and they're doing an MBA program in the business school. I find that those people are really great candidates for CEOs, even if they don't have the experience of being a CEO. They frequently come in with good technical knowledge. They have an MBA that they've now earned from the university, and they learn a lot of these MBA programs provide good guidance on how to lead companies. So that's another option to consider. And the second part of the question was, remind me, Patrick?
Yes, what can you share about submitting SBIR and the work associated with that stage of a company?
Okay, so there are two phases of SBIR, two main phases. There's phase 1 and phase 2. The phase 1 SBIR application is basically, if you've got a concept in mind, you probably qualify to submit an SBIR phase 1. It's a few $100,000. And what it does is it gets you sort of started down the path of SBIR funding. The application itself requires good commercial, you have to think about the commercial plan, although that's not a major part of a phase 1 SBIR, but I advise you to think about that when you submit an SBIR phase 1. But mostly it's technology and describing how the technology is going to solve a problem. And then if you get a phase one funded, it's usually for about a year, and it's a few $100,000. You then are in line for phase two, which is over could be over $1 million over a period of 3 years, and it's a bigger deal. It takes more work, but you have a better shot at getting a phase two if you've already been funded through a phase one. And my advice on SBIR applications is you're probably not going to get funded the first time around, so be prepared to listen to critique and go back and try again. A lot of companies do it 2 or 3 times before they get funded. And the other thing is on SBIRs and STTRs, you do need to be a company in order to submit and get funded through an SBIR application. Okay.
Okay, next question here from Bruce. Are mouse model results sufficient for a pitch, or do you really need non-human primate results or even clinical trial results?
The more advanced the data, the more compelling the story. But you can definitely, if you've got mouse data, that's better than just in vitro data. If you've got rabbit data, that's better than mouse data. If you've got human data, that's really ideal.
Okay, next question. Could you elaborate a bit on the current status of crowdfunding for an early startup company?
Yeah, I mean, I don't recommend crowdfunding. The problem with crowdfunding is that you get a whole bunch of probably inexperienced investors, people who are really not familiar with your technology, and they're all on your cap table. And one of the biggest problems with that is that when you go to subsequent raise money from sophisticated investors, they look at your cap table and they throw up their hands and say, I can't deal with this. There's too many people on this cap table. You could crowdfunding, you could get, $10 from somebody and they would be on your cap table. So you can do that. And some companies have raised a lot of money on crowdfunding, and then they have to hire lawyers and figure out how to clean up the cap table to make it more presentable to subsequent investors. It's probably better not to do that if you can. If you can't find any other way to raise money and that's the only way, then that's what you have to go with and deal with consequences.
Okay, thank you, Steve. That's currently all the questions I see in the Q&A. Mike, I see you have your hand raised, so please feel free to chime in.
Can't hear you, Mike.
Sorry. So Andrea, and this is for everyone. So Steve is also part of the innovation office at the NHLBI that supports all innovators thinking about the SBIR program. So I put in the chat the email address, and Steph Davis is a small business coordinator at the NHLBI. And it's really important that you seek them out before you're thinking about applying, because they can help set up what expectations you might have for staging your research, and get you in touch with the scientific expert at the NIH who would help you with your aims as well.
Thanks, Mike.
Great. I think is that all of our questions, Patrick?
So actually, we just got one more. I think we have time. You mentioned that marquee names are not helpful on your board, but do they help bring in more money?
Good question. I guess I would say that marquee names could bring in more money from non-sophisticated investors, which is something you may not want to do. Sophisticated investors know that marquee names are window dressing and they don't really help, and that's actually kind of a turnoff. So if they do bring in more money, it's probably from investors that you may not want to engage with. Just to point out that if you have the luxury to do this, I advise you to do diligence on your investors before you engage with them, simply because you don't want to bring investors into your company that make life hard on you. You want your investors to be supporting you. And non-sophisticated investors can be very disruptive and damaging to early stage companies. So just be careful about that.
Great. Thank you so much, Steve. And with that, I think we will move on to wrapping up this today's webinar. So thank you again, everybody, for joining. I'm just going to